Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for November 29th, 2022. I'm Ken Animo over here at DAT as Chief of Analytics. We have a very special guest today. We're joined by Lee Klasko from Bloomberg, and we have Dean Croak holding down the fort as our Principal Industry Analyst. Good morning, gentlemen.
Morning.
Morning, Ken.
You'll notice I'm a bit hoarse and a bit in mourning after that beat down at the hands of that team up north over the weekend. It was quite depressing.
Right.
I don't know that I'll ever fully recover, but we must move onward. Thank you for joining us, Lee. How are you?
I'm doing fantastic. Thanks for having me on today. Appreciate the opportunity to talk with you and your audience.
Right. Thanks. We have to get this out of the way before we get into the actual freight analytics. Do you have any college football allegiances? Allegiances?
I went to a Division III school. I went to Ithaca College, so my allegiance are with them. They just won the Cortica Jug Bowl, which is a big deal in Division III. They went up against their rival, and they beat them once again, so that was pretty exciting. Unfortunately, I couldn't go to the game live, which they had it in New York City this year, because I was away on a family trip for the Thanksgiving week.
Yeah, a good friend of our family went up to Ithaca, and they ended up staying in the area. School teacher up there, and really loved it. And from the pictures I saw, it was a beautiful campus.
As the bumper stickers you might have seen say, Ithaca is gorgeous, because it has a bunch of deep ravines that are fun to explore, especially in your 20s.
Yeah.
So we'll come back to later at the end, Lee, for the question of the week. But do you want to give folks just a quick intro on, your role and sort of your place in the freight analyst community?
Sure. So I work for Bloomberg LP, which is obviously the huge media company. Within Bloomberg, there's a research arm called Bloomberg Intelligence. Our research goes across the Bloomberg terminal, which a lot of your viewers might have seen. When you ever see a picture of a trading desk, most of those traders are operating with the Bloomberg terminal in front of them. And I cover about 22 individual names. They include trucking, rail, marine shipping, parcel providers, asset light logistic providers, as well as covering those industries. And we write our insights about those companies and industries, and again, that are available to our Bloomberg subscribers, which are roughly around 350,000 around the world. And Bloomberg Intelligence has over 300 analysts around the globe, covering a multitude of industries and companies, from not only an equity standpoint, which is how I look at things, but also through the lens of a credit analyst, regulatory analyst, strategy, and ESG.
Awesome. Well, thanks for joining us. Lee did a little bit of underselling there. He's by far one of the top analysts in the freight space. We were very fortunate to have him join us for one of our best sessions down in DATCon in October. So we're super thrilled to be partners and to have him on the program. We'll bring Lee back towards the end for our question of the week. But to move things along, I'm going to get on to our points of the week. So this is our holiday hangover edition of points of the week. It's probably the fewest words we've ever put up on screen here. But given the abbreviated time period, I think it's fitting. National spot rates are up as predicted. Seasonality is extremely dominant during these time periods over the holidays. ATA truckload tonnage dipped 2.3% in October, but still up 2.8% year over year. Again, I think there's an interesting point here to explore around tonnage versus shipments and how that has interplayed throughout the pandemic, with load factors being a major impact there. Steel production down 10.2% year over year, falling below 2016 levels. Not good for flatbed. I think you're going to see that manifest in our forecast later on. Typical pre-Thanksgiving rise in reefer rates failed to materialize. Dean's going to talk more about some of the shapes that have occurred over the past couple of weeks there. And then produce volumes 13% lower year over year in Florida, off to a slow start. I wonder how that compares to wine and spirits shipping, because I know that I substituted some of the vegetables for some of the more festive beverages. But with that, we're going to turn it over to Dean for our points of the week, or for our market update.
Yeah, thanks, Ken. Yeah, so overnight there's been some winter storms make news. Of course, today in Jackson, Mississippi, we've got tornado alerts, golf ball size hail and rain today. And then in the Pacific Northwest and California, we've got a 3-storm combo lined up. They're talking about up to 4 feet of snow. Even North California is going to get in on the action. So brokers add in some extra time for shipments in those regions this week. So let's start off the market update with our dry van load post volumes. They decreased to 2019 levels last week. Again, not surprising that they decreased, but it's the second lowest volume in the spot market recorded in the previous 6 years. Capacity tightened also, which is, again, as to be expected as carriers take time off. But the number of carriers posting their equipment on our load boards is about 24% higher than this time last year, a sign that the spot market capacity is still oversupplied. Load to truck ratio dropped to 2.13 last week. In refrigerated, load posts was somewhat muted last week. It was around half what we compared to last Thanksgiving. So load post volumes in reefer way down, but that's consistent with lower demand in some sectors. Produce, as Ken mentioned, is down. It's tracking about 4,000 fewer weekly loads of fruit and vegetables each week, to sort of give you a sense of what 13% lower year over year means. Florida's off to a very slow start, as we'll cover later. Carrier equipment posts about 15% higher over the same time frame compared to last year. Also at the highest level in the last 6 years. Load to truck ratio decreased slightly to 3.51. In flatbed, load posts followed a typical seasonal pattern during last week's short week. Both decreased as expected. Load posts are running about 70% lower compared to this time last year. In the spot market, carrier equipment posts remained at their highest level in 6 years and are now about 10% higher than the oversupplied 2019 market. Load to truck ratio decreased by 17% to 7.34 loads per truck. So having a look at our market condition index this week, let's start off in the Pacific Northwest, where weather is going to have a big impact on capacity this week. A short work week resulted in slightly higher line haul rates in most market. In Washington and Oregon, spot rates increased for the fourth week to $1.65 a mile. Remember, folks, these are line haul spot rates excluding fuel. $1.65 for all outbound loads, up 7 cents a mile last week. Regional rates in the Pacific Northwest are slightly above 2016 levels, though. In Seattle, rates increased 6 cents a mile to $1.38. Seattle to Los Angeles up to 91 cents a mile. But that's about 41 cents a mile higher than the October average, so some upward movement there. Further south in Los Angeles, after dropping for the prior 3 weeks, spot rates increased 6 cents a mile last week to $1.75. Next door in Ontario, California, rates increased by the same amount to an average of $1.89, excluding fuel. Loads from Los Angeles to Phoenix hit a 12-month low of $2.51 last week. That's exactly $2 per mile lower than this time last year. In Chicago, outbound line haul rates were up 6 cents a mile to $2.23. In Atlanta, rates decreased slightly to $1.63 a mile, down by 5 cents. Up in Elizabeth, New Jersey, rates increased 4 cents a mile to $1.60 per mile last week. Having a look at the refrigerated market, according to the USDA weekly truckload report, there was a shortage of trucks in eastern North Carolina last week, home to the nation's largest region of sweet potato production, also the second largest producer of turkeys and Christmas trees. Understandably, reefer capacity was tight last week. State level line haul rates up 13 cents a mile to $2.68, identical to 2017 and 2018 levels, though, about $1.14 per mile lower than this time last year. Short haul loads from Raleigh drove a lot of that market action. Raleigh to Richmond up to $9.49 per load. That reversed a 3-month slide on that short haul lane. Having looked at some of the West Coast markets in San Francisco, which includes the lettuce producing Salinas Valley, line haul rates increased 14 cents a mile to $2.05. Loads 1,400 miles north to Calgary, Alberta, very busy last week. Lots of demand on that lane. Rates are up to $2.17 last week. That reversed a 4-month slide on that long haul lane. In nearby Fresno, the largest produce market on the West Coast, rates up 4 cents a mile to $1.86. Having a look at the flatbed market, California will stay out there. Flatbed line haul rates are identical for outbound loads in California to 2018 levels. They were up 11 cents a mile last week to $2.18. That's the highest outbound flatbed rates have been in the last 6 weeks. In the specific Los Angeles market, rates jumped to $2.07 a mile last week, up 19 cents, driven mainly by tight capacity, though, on the short-haul San Diego lane. Higher volume lanes east from Los Angeles to Phoenix were at a 12-month low of $2.41. That's about $1.60 per mile lower for flatbed loads than this time last year. In the second largest Christmas tree producing state of North Carolina, flatbed line haul rates increased by 22 cents a mile last week to $2.47. almost identical to 2020 levels for this time of the year. And in the southeast, where hail is predicted today, lumber producing markets of Georgia, Mississippi, and Alabama spot rates up to $239 following last week's 14 cents per mile gain. And wrapping up with our year-over-year look at spot rates, seasonality emerged last week right on cue. That's Queue, just for those that are following social media. Line haul rates, but certainly, as you can see from the chart, at much more subdued level this Thanksgiving. A short work week and some carriers taking time off on the holiday weekend resulted in line haul rates increasing to $1.77 per mile, excluding fuel. Line haul rates up 6 cents a mile last week. Compared to the last two Thanksgivings, line haul rates averaged $2.39 per mile in 2020 and 21. Last week's national average was 63 cents per mile lower than the last 2 years, but still 8 cents a mile higher than non-pandemic years going back to 2016. The national average line haul rate of $1.77 is 28 cents a mile lower than the average of our top 50 dry van lanes based on loads moved, which was at 205 this week. Having a look at the refrigerated market, and as they always do in the lead up to Thanksgiving, line haul rates increased to $2.12 following last week's 4 cents per mile gain. Nothing like the 13 cents per mile gain we typically see in the lead up to Thanksgiving. The numbers look a little worse when you compare to the previous 2 years, though. At $2.12 a mile, last week's reefer line haul rate is exactly $1 per mile lower year over year and about 37 cents per mile lower than the prior 2-year average. Driving lower demand is weekly produce volumes, of course, which haven't been this low since 2016. Having a look at the flatbed market, our last of the trailer sections, after dropping for the prior 7 weeks, flatbed line haul rates increased last week by just a penny per mile. The national average ended last week at $2.05. Compared to the previous year, last week's average spot rate is 22% or 57 cents per mile lower, and now just 10 cents a mile lower than in 2017. Still about 20 cents per mile higher, though, than our watermark for flatbed rates, which was 2019, which was, of course, an oversupplied market for all equipment types. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. Greatly appreciated. So we're going to start with dry van, as we always do. Just a level set on this chart, the blue line is the historical observations going back to July 1st. And this is a 7-day weighted moving average, excluding fuel, for shipments over 250 miles. So you can see we've declined rates as we headed into the Thanksgiving holiday. When we move forward, the colorful lines, the green line is our ratecast forecast. It's our flagship forecast that you'll find in all of our products. The red line is our short-term forecast, which more heavily weights near-term data. And then the gray and the yellow lines are blends of the two. And I think what you see here is, again, we've been talking about this for months, it seems, model disagreement. What we got, sort of what we expected, the short-term forecast was substantially incorrect, as we talked about at least this week. But we knew that was sort of what was going to happen. Ratecast was pretty spot on. I think where these two things are going to play out over the next few weeks is what's going to really determine the market as we wrap up the year. Ratecast is projecting strength heading into the Christmas holiday. The short-term forecast is expecting us to dip back down before that final end of the year push. And the two middle forecasts are seeming to trend more towards ratecast this time around. Let's go to reefer real quick. Very similar story. You can see that the blue line in the very near term has started to already ebb back a bit, coming back off the Thanksgiving holiday. There's not as much optimism on ratecast, at least in the next couple of weeks. They all, of course, point upwards as we head into the Christmas holiday and the New Year, wrapping up 2022. The one area where we do see unfortunate agreement, I would say, is the flatbed sector. So if you look here, these forecasts have really hammered themselves into alignment. The only way they really difference is how the end of the year is going to pan out. And again, we've talked about a lot of this is driven by driver out of service and diminished freight volumes and sort of out of placement capacity as we head towards the end of the year for flatbed. I think the next few weeks will be important to watch to see how slow it truly gets before drivers go out of service for the new year. So with that, we're going to go back to our question of the week and bring Lee back on to discuss that. Dean?
Yeah, thanks, Ken. This is probably one of the more common questions we've been getting, Lee, certainly in the last 6 months. And the question of the week is really a good setup for you. And that is, how do you see 2023 shaping up for transportation?
Sure. So, 2023 is going to be another very interesting year, as all years tend to be. I think as we head into it, it's becoming very even more interesting given what's going on in the rail industry with the potential strike. That potential strike could force the rail industry to close down a lot of their network before a strike on December 9th to make sure that their employees get home safely in case of the strike, and also to let shippers, not have their freight lost in the rail systems. So a lot of shippers are probably looking for alternatives now to move those shipments. And that could, provide a small near-term boost to at least the trucking spot rate market as we see it. That coupled with low levels of the Mississippi, obviously not every movement that goes on a barge can be transferred easily onto a truck. But these are incremental positives for a spot market that's been really beaten up over the last 6 to 8 months. Now, with that tailwind going into 2023, trucking is going to be dealing with a lot of headwinds next year. Some of that has to do with on the contractual rate side. We see rates going down to low mid-single digits. A lot of that's due to a difficult comparison from the last 2 years, and then also, the fact that there was a lot of contractual business that was really most people would consider transactional in nature and short-term in nature, and those had really high rates that were probably not very sustainable. So those rates will probably come back to lower levels and kind of drag the overall contractual rates down. So you could see rates down 15 to 20% in some lanes, flat in other lanes. And so net, again, we see low to mid-single digit decline. I cover a lot of the publicly traded trucking companies, and earnings for those companies are expected to be down around 14% next year. And that's off of 2 crazy growth years. It's still going to be a very good year from a historical standpoint, but some of that has to do with the rate declines that we talked about. Some of that is going to have to do with volume demand. I mean, if you look at GDP estimates continue to move lower as the risk of a recession increases each day. And then not only that, but the trucking industry had a huge tailwind over the last couple of years with the sale of used equipment. Given the weakness in the spot market, values for used equipment has come down considerably. Also, with the OEMs kind of getting back to a more normalized supply chain, not quite where they need to be, but getting normal. So, we think it's going to be another challenging year for trucking in 2023. But we don't think the sky is falling and it's all doom and gloom. We think there'll be pockets of strength. And we expect the spot market may begin to turn in the second quarter, third quarter of next year as the market rebalances from what reality was too much capacity in the market over the last 8 months.
I think that pretty well aligns, Dean, with our sort of, we've been on this show talking about probably late Q1, early Q2 bottoming out of the spot market and then starting to think about moving upwards, and then contract probably lagging behind a quarter from there. And it pretty well aligns with what you just laid out from a timing perspective. Do you think if there is a material rail disruption, it could pull forward some of those estimates?
I think I think the rail issue is going to be a short-term benefit, because the reality is the federal government, the Biden administration and Congress are actually trying to get these people to the table and trying to hammer out agreement before the December 9th deadline. So probably any disruption is going to be created by, the rails, like they did last time, will be telling their customers, listen, we're not going to be accepting any freight for our intermodal networks because, again, they don't want that freight to be stuck in the system. And so, those shippers that really need stuff to get from point A to point B will look for alternatives, and that will benefit the trucking industry in December. But again, it's going to be a short-term benefit. So we don't think it's really going to be a structural change, at least from our initial outlook that we had prior to the risks of the strikes.
I'd agree with that. I think we're seeing since that September 16 rail strike threat, Lee, we've seen capacity increase and demand soften, especially if you look at the ATA index. It did drop in October about 2.3 points. So the last time the rail strike was threatened, the contract market capacity absorbed that rail volume that came over in that week. We didn't really see anything. It'll be interesting to see how this pans out now, to see whether the threat of the strike next week moves the needle this week, because this week would be the deadline for hazmat. If I understand the timeline correctly, we should be seeing some of that network volume shift later this week and possibly into the spot market. Big question I've got is, do we still have enough capacity to absorb that this time around? My instinct is that we've still got plenty of capacity in the market, because the prices, the spot rates in particular, are being driven by capacity more than demand at the moment. We've just got a lot of capacity that's entered in the last couple of years and continues to enter the market in all of the major class categories.
Yeah, and that capacity absorption would be a good thing. And in your market update, you mentioned that rates are still above pre-pandemic levels. The fact that rates are not as bad as some people might paint from a historical standpoint. The problem is that a lot of trucking companies that entered the market over the last 2 years have a much higher cost base because of higher equipment costs, higher insurance costs, and they're not used to operating in these environment where rates have come down and make turning a profit extremely challenging. And then you have some smaller carriers that might not be as disciplined with rates and just looking to cover cash flow versus profitability. And obviously in a commoditized business, the lowest price tends to set the new price.
Yeah.
I will add one thing though, right? I mean, so sometimes these shocks to the system can catalyze the market that's kind of anticipating a shift, right? So if the spot market is sort of nearing bottom, a potential large disruption before an end of the year push could shift things. I mean, so the polar vortex, when it affected Texas a year and a half or so ago, I mean, it really was only there and affected it for about a week, but it really sort of threw the entire market into a different point. Now, again, the counterpoint to the point I just made is that, but then Delta variant of COVID hit and kind of threw everything off of its axis. But I'm just curious, and I think a lot about how much does it kind of shift the fundamentals of where the market is at the moment if there is a prolonged disruption at the rail, because there's not enough trucks to capture all of that. I mean, it's 2 million trucks a day.
Well, I think the key is it's probably not going to be a prolonged disruption. It's probably going to be a short disruption, more of a hiccup versus a heart attack, if you will. So I don't think that it's going to have that much of an impact, longer term than the couple weeks from shippers scrambling to say, oh my God, I got to get my freight somewhere, and rails aren't an option. And I'm willing to pay more for the flexibility of a truck, which we all know trucking provides shippers with the most flexibility, but you're paying for that flexibility and higher rates versus shipping something on a rail.
I wonder, Lee, how much of the volume that would move on the rail traditionally that truckload could handle is for next season's inventory, for example. You'd have to think that a lot of rail volume right now is not for the current holiday season retail side of the equation. A lot of that volume has to be for next year. So I'm just wondering whether shippers have the propensity to hold on to things longer, have a longer lead time, let them sit in transit longer. Do you have a sense of what that might look like?
Yeah, and that's part of the reason why it's going to be a short-term blip, and as a lot of people on this show probably know, and there's a lot of retailers out there that have said that their inventory levels are too high. So if a shipper has the ability to kind of slow down when the inventory reaches their warehouses, that would be a good thing. That's why we don't expect like all of the rail shipments to jump on a truck. It's going to be a select amount, and we can all put our finger in the air and kind of guess like what that's going to be, but it's probably going to be, you know, a relatively small percentage. And again, that's why, you know, we think it's going to be a localized short-term benefit for the spot market versus, okay, this is the bottom, we're going to go up higher from here into 2023. And that's why we expect, you know, second quarter, late second quarter, early third quarter to be really kind of when things start to turn around. Because, you know, I think, you know, Dean, you mentioned earlier, you know, it's really on the supply side. We think enough supply will be flushed out of the market by then, where it, you know, where the market is quote unquote rebalanced, and you could see rates, you know, build from there. But, you know, as you guys know, this is a, you know, a very fluid market. It's very easy to start a trucking company. I'm not saying it's easy to run a profitable trucking company. That is extremely difficult. But, you know, you need a CDL and a couple $1,000 and you can hit the road, especially with, you know, all the online tools like a DAT can provide trucking companies that can be a little more competitive than maybe they were able to be 10 years ago.
Exactly. Yeah.
I mean, I think it's going to be it's always interesting where these things top out and then sort of trough out at the beginning and end of cycles, right? In the middle of the cycle, you sort of know where you're headed or where you're going, right? It's kind of a foregone conclusion. What you're looking to see is where you top out and then ultimately like where's the floor. And, you know, from a market fundamentals perspective, I'm very interested in where things bottom out compared to the last two cycles. Like how much ground did we really gain? Because the most fascinating thing about the ELT driven cycle in 17 and 18 was that we bottomed back out no more than a few cents above where the prior cycle was, which was remarkable, right? We traveled all that way to sort of arrive in the same place. And given some of the fundamental changes in cost, I'm curious as to whether that's going to happen this time or not. I find it hard to believe that it will, but this market will keep you guessing.
It certainly will, and to your point, I mean, you know, the trucking companies and individual operators are facing higher costs like they've never faced before. You know, you have insurance costs that have skyrocketed. We're operating in a relatively high fuel environment. You know, equipment costs are extremely high, and because of fuel costs, everything to maintain your truck, you know, costs more. And so, you know, you kind of need a higher base rate, if you will, than you did a year ago or 2 years ago, or even 3 years ago, to try to, you know, generate, you know, a decent return to want to stay in business and reinvest in your business. Because if, you know, if you're a company and you're not making that return, there's really no need for you to reinvest in the equipment. And, you know, shippers need to know that if fleets are not reinvesting in their equipment, then you're not going to have, you know, a high quality trucking service, which the reality is that, you know, the U.S. trucking market and the North American trucking market for that matter is a very high quality service that shippers rely on, and we all rely on for, you know, our day-to-day, you know, everything we do each and every day.
Lee, you mentioned supply. One of the things we've been watching is the new truck and trailer orders that ACT Research have been reporting. We had some record numbers come through now. Order books are open. So a lot of your large truckload carriers you're following have a pretty bullish outlook for next year if you just think about new truck orders. My question is, you mentioned something about you know, service. One of the things that's affecting service and retention is the aging fleet. You know, so a lot of carriers want to buy new trucks to keep the latest technology, certainly as a driver retention tool, but to keep with their regular trade cycles. So do you have a sense of what carriers might do next year as all of these trucks start to come out of the factories in Q3? Does that simply mean that capacity stays the same and carriers retire their aging equipment that they've kept a little bit longer during the pandemic because of the component supply problems?
Yeah, so it was interesting. I was at the ATA trucking conference last month, and I spoke to a lot of trucking executives. And what I found most interesting about when they were talking about their fleets is that they were usually they might have operated with one or two trucking OEMs in terms of the fleet that they operate on. Obviously, the less amount of tractors, types of tractors that you have, the better you can control your maintenance costs. They were all talking to other trucking companies to try to get better allocations and looking to increase, from two types of trucks to four types of trucks. So if they ran Navistar and Freightliner, they're talking to Peterbilt and Mack as well to try to get more trucks. And the reason why they want to do that, to your point, is they want to lower the age of their fleet to lower their overall costs and increase their reliability. So I think that's a very, very interesting trend. And obviously it waterfalls, right? So if a large fleet like Werner is looking to sell trucks that are 3 or 4 years old, the owner operator that is, maybe driving a 15-year-old truck might be able to buy that truck and lower his or her maintenance costs and increase their reliability. So it's a waterfall event, and then you have the really old trucks that just end up, going to the scrapyard. Because the reality is that the large fleets are looking for more trucks, but they can't or they're not willing to grow their fleets. A, because they can't find enough drivers, or B, they want to be more asset light, so they're relying on more of the owner operators for growth. And if they are growing, they're looking more or less at their dedicated businesses instead of their over-the-road or regular route businesses, because it's more reliable from a return on invested capital standpoint and a cash flow standpoint.
Great point.
I had one more question. I know this isn't your exact area of expertise, but I know that you've spoken on it before. How do you see the fuel environment through at least the first half of next year for truckers?
I mean, it's hard to think of a time when fuel is going to come down considerably, given the war in Ukraine and the impact that is having on global oil supplies and oil prices. Also, you have OPEC plus always talking about lowering what they're supplying the world, and those lower estimates are really being driven on a global economy that is not growing as quickly as many might have thought. So I don't see that changing dramatically. Obviously, diesel prices might be even more difficult to predict than spot rates in the truckload market, given all the volatility and the global aspect of the market. But unless something changes considerably with, again, the war in Ukraine, I don't see any major downward pressure on fuel. The only thing that would create that really is the economy getting worse, and that won't be good for trucking or anybody. So let's hope that doesn't happen, and let's hope that the war in Ukraine ends yesterday versus tomorrow.
Yep.
Yeah, I mean, far be it from me to hope against market dynamics, but I'd like to kind of get back to a point. I don't want to see this stick to a new normal where we see these sort of spreads between retail, wholesale, and crude prices, right? It's sort of been out of whack for so long, especially compared to gasoline markets, that I hope this doesn't sort of settle in as a new norm, because I think that will be overall negative for the truck driver, especially the independent contractor.
Yeah, and diesel also had issues where a lot of refineries were shutting down for normal maintenance, and that just happened at an opportune time with what happened in the global markets, and so that put somewhat upward pressure on diesel prices. Obviously, as more of those refineries come back online, that might relieve some of that upward pressure. But again, unless something happens, constructive with Russia's war in Ukraine, we don't expect anything major happening in terms of a significant stair step lower, outside of the kind of slow downward trend that we've been seeing.
Got it.
Great. All right, I know we're a bit over time, but this has been a great conversation. Dean, do you want to do some plugs real quick?
Yeah, quickly. I'll be on recording the FreightWorks Life by the Mile podcast this afternoon. Look for that to be released next week. Of course, I'm on Sales Chatter tomorrow with Dan Deegan, Ryan Muhammad, and Jeff Dickinson at 9 a.m. Eastern. Robert Rouse from DAT is going to be on Landline now on Wednesday. Don't forget, on the latest Freight Vine podcast, Ben Steffes from Coyote Logistics will be on. I think that's released Thursday this week. Scott Friesen from Echo was on last week. And then coming up in a couple of weeks is Jeff Tucker from Tucker Worldwide Company. Remember, you can find out all about the market update at dat.com/market update or on our new IQ dashboard at iq.dat.com. And with that, it's back to Ken to wrap up the show.
Lee, how can folks get in touch with you to read your writing, and then also I know you do podcasts and other type of stuff.
Yeah, so most of my stuff is actually on the Bloomberg terminal that we do. We do also have stuff on Bloomberg.com. If you want to reach out to me, I'm on LinkedIn, also on Twitter at LogisticsLee, and love to talk to people about the market. It helps me do more impactful research. So if someone wants to reach out and challenge anything that I have to say, I'd love to hear from you to help me be a little smarter.
Thanks,
All right. Well, I want to thank everyone for joining us. It was really great. We're going to have to make this a pretty regular thing with Lee. I always learn something when we have a conversation. We will see everyone. Who's our guest next week, Dean?
Christina Ellington is on next week, and then we've got Tim DeNoyer from Act Research, and then the week after that, before Christmas, we've got Jason Miller from Michigan State University.
Quite the murderer's row this week concluded to finish out the year. So I guess with that, the only thing I have to add is that I'm really going to be pulling for Kansas State and or Utah this weekend as we head up to the Deer Camp and watch that unfold. Hopefully the Buckeyes can back into the playoff and make some noise. But if not, I'll be happy with the Rose Bowl. Thanks, everyone, again for joining us. We hope you had a great holiday and hope you have a productive week back at it. And we'll see you next Tuesday at 10. Bye, everyone.